on the heels of this big Fed press conference and this 75 basis point rate hike, we are looking at a market. We're looking at the NASDAQ 100 at one point as high, rising the most since 2020 here. And you pair that with a massive GDP print tomorrow. You pair that with Fed Chair Powell telling you that the labor market is going to soften and the path to a recession is more narrow than before. You've been saying a recession is inevitable here. How do you pair the market exuberance here with the fact that we might be facing a massive slowdown?
Well, I think that there is a relief here on the part of the market that the Fed is basically in the process of pivoting. And so if you look at the NASDAQ in particular, Sonali, you see a market that has been being driven by interest rates more than anything else, more so than the Dow or the S&P. And so that relief rally that we're getting today is really related to the fact that they believe that the Fed is not going to be as hawkish as has been advertised, and that's going to be in the near term good for rates and therefore good for in particular tech stocks.
Yeah, Scott, do you agree with the Fed chair that we're not in a recession at the moment?
No, Caroline, no, I don't agree at all. I think that it is really hard to argue that we're not in a recession, given the fact that, for instance, just one indicator, the leading economic indicators have had 4 down prints in a row on a monthly basis. Every time that's ever happened, that is essentially a signal that we are in or we are about to enter a recession. I think the chair is hanging his hat on the idea that, well, we could very well have 2 negative quarters of growth. We could continue to have a contraction in growth, but until it spills over into the labor market, we shouldn't call it a recession. And so I guess it's a semantics game after that as to whether we're in a recession or not. But I would say a contraction in economic activity is a recession.